Good afternoon, everybody. We're going to go ahead and get started. I want to welcome you to this CSG eCademy webinar presented in partnership with the Griffith Insurance Education Foundation. Our topic today, rideshare companies, insurance and regulatory issues for states. My name is Sean Sloan. I'm the Director of Transportation and Infrastructure Policy at the Council of State Governments in Lexington, Kentucky. CSG is excited to partner with the Griffith Foundation on this webinar and a series of other events to provide information to our members about what has become a key issue in many state capitals in recent years, the regulation of services like Uber and Lyft. To say more about the partnership, I want to call on Frank Paul Tomasello, the Program Director at the Griffith Foundation in Malvern, Pennsylvania. Frank?
Thank you, Sean. The Griffith Insurance Education Foundation is excited about its collaboration with CSG. Our organizations have come together for the purpose of providing state public policymakers with unbiased, nonpartisan educational programming on emerging risk management and insurance issues. And today's session, discussing the insurance-related regulatory and legislative landscape surrounding ride-sharing services, is the first of several collaborative programs that we'll present in conjunction with CSG this year. Importantly, both Griffith and CSG share similar missions, which include a commitment to an unbiased academic approach to programming, and that focus is at the heart of our collaborative effort. Before we begin today's presentation, I want to send things back to you, Sean, to quickly cover some webinar logistics.
Thanks, Frank. We want to dive into our topic and hear from our speaker, but before we do, just a quick note on how the webinar will run. If you have a question for our speaker, you may type it into the GoToWebinar interface at any time, and we will collate those here in Lexington and ask as many as time allows today. Our speaker this afternoon is Dr. Tim Stinking, an Assistant Professor of Finance at California State University in Sacramento. He received his doctorate from the University of Pennsylvania's Wharton School, an MBA at the University of California, Berkeley, and a bachelor's degree from Brigham Young University. He has nearly 3 decades of academic and practical experience, including having served in senior-level technical leadership positions at the Inter-American Development Bank. Dr. Stinking is going to take us through why rideshare services have had such an impact, the challenges facing the insurance industry, regulators, and legislators as a result, and where he expects things to go in the future. Dr. Stinking, the floor is yours.
Frank and Sean, thank you very much. It's a privilege to be here with you and your members, and I'm looking forward to having a good discussion with you. The concept of ride sharing, which is what we're looking at today, is not really new, but it exemplifies how advances in technology can really impact the ways we live and work, and to a certain extent how we utilize our scarce resources. However, at the same time, it creates it raises serious questions about technology and the new economy and how these are entering uncharted waters in terms of regulation and legislation. And as my focus is on risk management and insurance, I'm also interested in exploring the challenges posed on insurance markets. There's a large conflict between the coverages that have been assumed by ride-sharing companies and the perception of insurers of higher risk levels associated with ride-sharing. And there's a challenge in reaching a stable equilibrium. I should, as normally, state that the views that are being expressed are mine. They're not those of the Griffith Foundation, the Council of State Governments, or of my university, Sacramento State. Ride sharing and its relationship to the legal and regulatory frontier is just changing. Just when you think you know it, it understands. So let's move to the introductory slide. Okay. When we're talking about how it changes, we need to think about how it is constantly changing. every time we think that we understand what ride sharing is, there's some kind of change that takes place. If we look just at the last 2 weeks, we have a ruling from a labor commissioner's office in California that an Uber driver was an employee and not an independent contractor, as the ride-sharing companies all state, reversing a ruling on an identical case that they'd made 2 years earlier. There's a similar process with a federal judge whose preliminary statements regarding being an employee or being an independent contractor's preliminary statements seem to not give a lot of credence to the view of the ride-sharing company. In Florida, there was a similar ruling where somebody that had stopped working at one of the ride-sharing companies applied for unemployment, and the Florida Department of Economic Opportunity, the group that grants somebody unemployment status, indicated that he was an employee because he could only get unemployment status as an employee. So there's just a lot of changes that are taking place. Let's go to the we've already gone to the next slide. And the idea is really there's nothing new under the sun. So let me give you a little bit of the history of the ride-sharing economy and the idea of why it exists. In some ways, this is Dogwood Bumstead borrowing a tool from his neighbor or trying to get the tool back from his neighbor. We have a long history of sharing. We build libraries because not everyone can afford all the books that they want to have. We set up public transportation systems as governments or municipalities in order to share that cost among everyone. There's lots of examples of convenience. We have ride pools. When I was at the university a long time ago, we used to have ride-sharing boards that if I was trying to get a ride to Northern California, I could put up my contact information saying I'm willing to go. I'll share the price of gas, and we get a group together to travel. A family friend has a larger pickup truck that their family purchased because they all need a pickup truck every once in a while. This idea that assets are too expensive for any individual to own, or for many individuals to own, is what's underlying this idea of sharing, that it's just convenient. Next slide. And so what we are trying to do, and what the ride-sharing companies and the drivers and the users of it are, this idea of unlocking value in unutilized assets. From an economic point of view, one purchases an asset to be productive. Businesses do that. We make investments where we hope that the net present value of those investments will be positive. As individuals, we also make those kind of investments. We purchase cars to provide transportation, to allow us to get to work and back. But for a large part of what we're doing, those assets are not really utilized. Most of us will have a car, we'll drive it to work, we'll sit in a parking lot, we'll drive home. On the weekend, we'll drive to a soccer game, we'll sit there for a couple of hours, we'll drive home. Most of the time, our cars are sitting parked someplace. They're not being driven. And so this is an example of an asset which is not really utilized. It's not, you're not getting something out of it. And there are individuals who would like to get value out of their automobile. They may not be employed, so they may be looking for some way to unlock the value of that asset they own. As I note in this slide that these assets can be wasting assets, or they can be stores of value. Most often we see the ones that are wasting assets. And unlocking the value of these assets also is creating value for the users. It's not just the driver that benefits from his asset being unlocked, his car being unlocked, being used to generate income, but it creates a benefit for the passenger that's looking for a ride, that may not want to buy a car, that may just need a this kind of service occasionally. And they may not have taxis in their areas, or it may be difficult to hire taxis, so you may look to ride sharing for this. I just want to, if we can go to the next slide, I just want to talk to you a little bit about how we can look at the value of a wasting asset and why one might want to unlock that value. And I'm looking at the depreciation of an automobile over 5 years of ownership. This is just a very general graph. Maybe it'll be different for each kind of car you have, but we're looking at a car that's cost almost $30,000. When you purchase it, you sign the money and you drive it off the lot. If you decide to sell it in order to get your money back because you need it for something, you can sell it for about $27,000. You've had a drop in value of almost 10% just by driving it off the lot. By the end of the year, you've had another 10% drop. Together we have a 19% drop in the value in the first year. And beyond that, for the next 3 years, for the next 4 years, for year 2, year 3, year 4, and year 5, we're having an approximately 10% drop in value every year. So at the end of 5 years, our $30,000 car is now worth $12,000. And people are looking at that and saying, is that needed? Do I need to be losing that kind of value? And let's see if we can unlock the value. So let's look at the next slide. The idea that has come up by the ride-sharing companies, often referred to as TNCs, these transportation network companies, is that they will set up a technological platform that will provide drivers who are interested in unlocking the value of these underutilized assets to provide income, as well as provide a service to passengers who would like to have those services, but by doing that, they don't need to purchase a similar asset that will also be underutilized. They're sharing that ride service among a large number of drivers and a large number of passengers. And what the technological platform does is it connects the passengers and drivers through a smartphone. It helps them manage the payments. They don't have to worry about cash payments. It's already locked into it. We reduce the asymmetric information because passengers and drivers are able to rate each other. If somebody is not a very good driver, an unsafe driver, somebody is able to put that rating in, and other passengers can look at that rating depending on depending if they want to use that driver or not. And finally, they extract some of the economic rents. The drivers and passengers are really not able to link up on their own, so they use the technological platform, which can extract as much as 20 or 25% of the value. So in many ways, this is the win-win-win scenario, an emphasis on the win for the technological platform in order to create value that goes all around. Just what we're looking for in our business classes. Let's go to the next slide. At the same time, these transportation network companies, and this is a name that came up from the California Public Utilities Commission to designate these technological platforms, and it's now become widely used. They started asking the question, after ride-sharing became common in San Francisco and Los Angeles, where it was no longer this was something that happened every once in a while, but it was happening all the time, and it was really motivated by a very serious accident that happened in San Francisco, where a ride-sharing driver, while he was looking at his app, trying to find a place where he could pick up somebody, ran up on a curve and ran into a group of children, ran into a family and killed a 6 or 7-year-old child. And so the Public Utility Commission started looking at that and saying, we don't have any regulation for these. They asked the question, should they be regulated? The perspective of the transportation network companies, these TNCs, was, no, we're not really subject to regulation. We're no different than a carpool. The Public Utility Commission came back and said, yes, you are subject to regulation. We are making, you are providing a taxi-like service, a livery type of service, and that is subject to regulation. And then the next question, should the regulation be similar to that of taxi or livery services? How do we do the background checks of drivers? These were things that the rideshare companies were already doing. They were doing background checks of drivers, but were these sufficient, etc. And as can be imagined, the major opposition for these ride-sharing companies came from the taxi lobbies, the taxi owners, who were seeing competition from somebody who was unregulated, who did not have to follow the strict regulation that they had. Go to the next slide. I've listed these as judicial issues under the court, but in many cases these have also been legislative issues. And first of all, saying, is ride sharing legal? And depending on the state, this has been determined by a judge, or by the legislature, or by a public utilities commission. And then they ask the question, who's going to be responsible for paying claims if there is an accident? Is it the TNC that's responsible for making the payment, or is it the individual's driver's insurance coverage? Is it really, is the coverage that they're having sufficient? Do they need to be having commercial insurance? Can we go on one more slide? And then there are the regulatory issues that really are related to insurance. Again, who's responsible in the case of an accident? Who has to be making a payment? Initially, the TNCs just assumed that the driver's personal automobile insurance covered them, that would be sufficient. They could choose the level of coverage that they wanted, and that was sufficient. Then they came up with a question: is commercial insurance needed? Taxi drivers pay a much higher level of insurance for their coverage than the driver's personal automobile insurance. Is the driver purchasing sufficient insurance? Does his insurer allow that insurance? To a large extent, most insurance policies prohibit the use of a car as a livery service. Find a carpool, that's not a problem. But if you're picking up people at a bar and taking them home at night, you're providing a service which is prohibited under your personal auto insurance contract. Will they cancel the coverage for that? They have the right to do that. Will they cover the claim if it happens? And these issues became so much more important as ride sharing grew. I just want to point out that this insurance perspective has really changed over time. It happened as people and insurers started seeing what was happening. At first, they didn't completely understand it, but they continued to really struggle to work on these insurance issues. By using again California as an issue, and I'm using California because it's one of the first states that went through this process, because the TNCs were all headquartered in the San Francisco area, and they started their services there. It started off with the California Public Utilities Commission going through and asking these questions. And then Dave Jones, the insurance commissioner, wrote a very detailed letter to the CPCU, the California Public Utilities Commission, regarding insurance issues that were not met. And I kept waiting to hear something from the California Public Utilities Commission about what was going on, and not recognizing that there was legislation taking place. And many of the suggestions of Commissioner Jones were included in that legislation, along with a directive for the Department of Insurance to do a review of coverage. Let's go to the next slide. So Sean, did you want to say something?
Yeah, so we just want to provide folks a quick reminder here that if you have a question for Dr. Staking, you can type it into the GoToWebinar interface on your computer screen at any time, and we're collecting and collating those here in Lexington, and we'll ask as many as time allows during the course of or at the end of the program. And I just want to ask you a question here initially to sort of hopefully prime the pump and get folks excited about asking questions and everything. You know, you talked a lot in this first part of the presentation about the nomenclature issue. You know, we talk about these companies within the context of the sharing economy, and they've been referred to, you know, for several years as rideshare companies, and you explained why that, you know, came about and everything. But there's been a more recent suggestion that the term is a bit of a misnomer, and perhaps it makes more sense to refer to them by the action of what the users are doing when they use these companies. So the AP style book sort of prefers the terms ride-hailing or ride-booking services now. And we also heard you describe, you know, the transportation network companies, or TNCs, as they're called within the context of a lot of the legislation around these companies. But what term do you think actually makes the most sense, given the nature of what these companies actually are and how they fit into the regulatory landscape?
Okay. I have to start by saying I like the term transportation network companies for regulation and legislation. I think it clearly describes what they are. It's a common terminology that people that are studying the issue understand, and shows how they're different from taxis, from carpooling, from other kinds of livery services, you know, limousines, etc. And I don't think the term transportation network companies has been used much outside of the regulation. The other terms that you mentioned, the ride booking, the ride hailing, and the ride sharing, all have the basically the same issue. Again, it's my preference for ride sharing because that's the term that's commonly used by individuals. They understand what they mean. It's understood by the drivers, it's understood by the passengers, it's understood by insurers. It's really entered the lexicon, and you know, the term ride hailing, which is occasionally used, is one that I really don't like, because for me that sounds like somebody's standing hailing a taxi, and that's a prohibited activity by the ride-sharing companies. You know, if you're doing this independently, you become a taxi. Ride-sharers need to have an appointment made through their app, and in fact, as we're looking at the insurance issues that are coming up, if a ride-share participant drops somebody off, and there's somebody there that wants to get in, they have no insurance coverage for that. There's no insurance coverage provided by their personal auto insurance, and there's no insurance coverage provided by the the ride-sharing company. So that one is really problematic. Ride booking seems to be imprecise. I can book a ride with a taxi. I can call up a taxi company and saying, I'd like to book a ride, come pick me up, take me to the airport tomorrow morning at 6 o'clock. I have a 9 o'clock flight to catch. There are just many ways that one can book rides that are sort of outside of what we're thinking of ride sharing. I hope that's a reasonable explanation. Again, the terms can be used, but I think that the ride sharing is the more applicable one. So start writing down your questions. We're going to have a good amount of time at the end to answer them, and often we learn most from each other as we're exploring questions and moving forward. So if we can move on to the next slide. I love this graph because it's the opposite of what we're teaching our finance and students to do. We're supposed to be creating value, not losing value. And so I said, next time listen to your actuaries. You need to have somebody that understands the risks that you're undertaking. And I want you to just pause for a minute and think about how the risks of a rideshare driver may be different from the risks of the general population. And the problem is we have quite a bit of heterogeneity. We have some people that are full-time rideshare drivers. They work 40 hours a week. There are some that are noted as working far more than 40 hours in a specific week. But there are some that are really doing this full-time. There are others that do it on a very occasional basis. They may do it 10 hours a week or 5 hours a week. They may do it on a Friday or Saturday night when they're going into San Francisco or into another large city in the central areas, and they go to the bar district, and they're looking for people that are coming out from a late dinner. They've had a little bit much to drink, and they will give them a ride home, and get a charge for that. They may be able to get a number of fares on that Friday and Saturday evening and earn a good amount of money. It could be students that are just earning a little bit of extra cash to keep them going, but their full-time job is being a student. So let's think of how an actuary would look at this. As I mentioned in the beginning, our typical driver doesn't utilize his car very much. It sits in the parking lot a lot. It sits at home. It sits at home overnight. It's in an area where the actuaries and the underwriters understand what the risks are for that area. A rideshare driver may be driving far more miles. They may be very active when there's inclement weather. Rather than driving home, they're driving out and trying to find people that are getting home. They may be working late at night. They may be working and taking people to parts of the city that they don't know well, that may have a different risk level. And so if they finish their evening run on Friday and Saturday at 1 or 2 in the morning, then they're driving home very late at night. So the actuary is saying, this is not the same risk as driving a car. And if we insured them at the same price that we insured a car, we would be losing money. So let's go to the next slide. And I'm using this slide from Lyft, one of our major ride-sharing companies. Uber and Sidecar both have very similar processes, but I think this is a good description, and you'll find a lot written in the press, written in the analysis about 3 periods: period 1, period 2, and period 3. They've changed this recently to this one where we have the dark line. The app is turned off. They're not doing ride sharing. They're going to the grocery store. They're going to pick up their kids at school. They're going to a soccer game. They're just doing something completely on their own. They're not ride sharing. This is a part that's really not talked a lot about in the regulations. And so I'm going to call this period 0. Period 1 is where the driver is in his car, he turns the app on, and he may be driving around or he may be parked someplace looking for a match. And at that time he has a match, from at that period that he had a match is where that sort of reddish pink line is on the top. And they're saying we're now in the driver mode. Originally, well, I say originally the rideshare companies were assuming that the individual's personal automobile would cover them for everything. The personal automobile policies came back and says, no, we don't cover that. And so they started off providing coverage when somebody was in the car. So again, going across, we had period 1 where the app was off, period 2 when you're in driver mode, up until you have the match notification. That would be period 1. Period 2 would be going from the match notification to when you pick up the passenger. And then period 3 would be while you had the passenger in the car and you drop them off. Initially, the rideshare companies started providing this contingent commercial automobile insurance just for period 3, where it'd be drop-down protection. You go to your personal insurer, and if they denied the claim because you were ride-sharing, then you could come to that commercial automobile insurance. Under significant pressure from regulators and legislatures, those last 2 periods, period 2 and period 3, have been merged together. So from the time you have the notification of a match and you're going to pick up somebody to when you finally drop them off, we have primary commercial automobile insurance with a $1 million limit. And then we have also this contingent collision and comprehensive company. Again, this is contingent. The ride-sharing companies are still thinking you should turn that into your private insurer, your personal insurer, but if they don't cover it, then they will cover up to $50,000 for your property, for your car and for any other car or property that you, or signpost or light post or anything you may have put into. In Lyft's case, they have a $2,500 deductible in that. Uber has a $1,000 deductible. If we go back to that middle section, again, let's talk about contingent liability when you're in that driver mode. And this is something that the ride-sharing companies set up, where, again, if your personal automobile policy denied the claim, then they would provide this lower level of coverage, $50,000 per person for bodily injury, $100,000 for accident for bodily injury, up to $25,000 per accident. Here, Sidecar, which is sort of the third largest of the ride-sharing companies, actually has commercial coverage there, which is not contingent, but that's where they are right now. So we have this funny blend of having your personal automobile policy from the app onto the driver mode, then your personal automobile policy when you're in the driver mode, unless they don't unless they deny the claim, and then the contingent liability comes in, and then finally you have commercial insurance with fairly high deductibles. And again, with a contingent collision in comprehensive coverage being, again, if your personal auto policy doesn't cover it. I would note that the insurance that's provided from the time that a match is made until the passenger is dropped off, this $1 million coverage, is far higher than what is provided for most taxi companies. In California, we have a $750,000 liability limit, in San Francisco and Los Angeles, and about $500,000 in most other parts of the state. These minimum requirements will change from jurisdiction to jurisdiction. But I want you to think about these three periods, and think particularly about the contingent liability in that when you're in that driver mode. Let's go to the next slide. And again, I want you to think about the incentives that are created by the existing rideshare insurance coverage. If I am a driver that works for Lyft or Uber, and I have my app turned on, and I get into an accident, what do I do? Do I call up my primary insurance company and tell them that I was riding with my app on and I got into an accident, and risk having that insurance company that you have for your personal auto policy tell you that we don't cover that, and in fact we're canceling your policy because you misrepresented that you were doing providing livery services, which is prohibited by your policy. So many of the insurance companies are just canceling people if they inform them that they're doing ride sharing, or if they get in an accident as while they're doing ride sharing, they're going to cancel that coverage. And then they'll deny the coverage, and then you go to the coverage that's providing by the ride-sharing company, by the TNC, as contingent coverage, which will cover you, but up to fairly low levels, much lower than you may choose to have on your car, much lower than most automobile agents would be recommending that somebody would be having. So the other is that you try to, you could try to go directly to the TNC to do that, and their instructions are very clear. You have to file it first with your primary insurer, and so the incentive exists that if my app was on and I didn't have anybody in the car, I was under that contingent period, I'm just going to call up my insurance company and tell them that I had an accident and ask them to pay for it, not revealing that I have that insurance. And we've seen online that people have taken surveys of rideshare drivers about insurance and what they would do, and a large number of them answer that they would just tell the insurance company that they got into an accident rather than telling them that they're doing ride sharing. This is our actuary's nightmare. Somebody is working with this risky business. They're staring at their cell phone that's attached to the car, trying to see if there's a match. If there's a good match, they want to do it. They're in a riskier driving status than most drivers. They'll have more accidents than the typical driver because they're driving more, but they're being charged the same policy. And even though the coverage should be covered by the TNC, the insurance companies end up being stuck with it a number of times. Let's go to the next period, and to the next slide. And here, what I want to address is the insurance gaps. For the passengers, as I mentioned, the coverage is generally equal or better than the coverage in taxis. Once they're in the car, even today, once the driver is going over to pick them up, they have a very high level of coverage, much higher than most individuals carry. With the drivers, they have a low level of coverage during the contingent period. But more importantly than that, they have no workers' compensation insurance. If they get injured, if they're out of work, they're on their own. They're on their own to get life and medical insurance. They're on their own to get disability insurance. It becomes a very risky proposition for the drivers who are spending a lot of time driving and have a higher likelihood of being injured, being off work, being unable to work, or becoming disabled because they're spending more time on the road, driving in unusual parts of the city late at night, at times of inclement weather, etc. Let's go to the next slide. I also think that we need to look at insurance gaps, and I would possibly refer to these as risk management gaps for the ride-sharing companies, our transportation network companies. There are court cases that are challenging this independent employee status. In the example that I gave in California, where the labor board, this is not a judicial ruling that can be used as a precedent. It's only available for that one individual. They declared that the driver was an employee, and that and they were an employee for about 12 months, and they required the ride-sharing companies to pay them back for the gas that they used, for the cost of insurance, for the cost of maintenance and repairs during that period. I am certain that this case will be challenged by the ride-sharing companies. It's very different from what they're doing, but there are a lot of court cases that are looking at challenging this independent employee status. There's legislation that's coming up in some cities and in some states regarding the legality of ride sharing. In California, there was an initial cease and desist order from the California Public Utilities Commission until they were able to reach an agreement about some of these important regulatory issues. The transportation network companies continue to provide the service as they were appealing it. And then finally, there's the risk of piercing the corporate veil in the event of a major accident. I could just see a driver late at night, after working all day, just not noticing a stop sign and running into a school bus that was coming home from taking people home from a football game, and killed and injured a large number of individuals, where the cost will be far higher than the $1 million in coverage that's provided. I wouldn't be surprised if the transportation network company were assigned responsibilities above that $1 million limit for those kind of serious accidents. I'm not a lawyer, so I'm not trying to give legal advice, but I think it's something that needs to be properly looked at. Let's go to the next page. I really think that there's a need for innovation in the insurance markets. The initial reaction of the insurance companies were sort of a herd mentality, saying our insurance forms, the standard form that we all use or that we make minor modifications to, excludes coverage for livery activities, for the transportation of passengers for hire. Therefore, they just said, you know, we're not covering this. When you talk to individual claims, senior claims level people, they say, you know, if somebody's using it during the period where the app is off, they're probably not going to deny the claim, but they are very concerned with the people that are doing it for a lot of time. It becomes a big data problem. When does the driver have the app on? When does he not have it on? When do they have a customer in it? Where are they driving it? What time of night? What's the location that they're driving in? How are they driving? You know, are they speeding? Are they trying to rush to an area where there are lots of people picked up and other ride-sharing drivers are doing the same thing? So this is a big data problem, but one that can be solved, and the TNCs are actually working with some selected insurers to provide policies for rideshare drivers. My question is, why has there been such a delay? This should not be difficult for an actuary to look to a solution if they had information, and then as the information evolved, they could be fine-tuning it over a number of years. And if I were making this presentation 6 months ago, there were no insurance companies that provided coverage. I was involved in writing a white paper for the CPCU Society, the Chartered Property Underwriter Association, on the need for innovations in ride sharing and home sharing markets. And there were no insurers that were providing that coverage. Let's go to the next slide. At the end of that process, so if we're going back maybe 4 months, there were 2 companies that were providing this. Metromile, a company that was set up in California, whose owners include the people that own Uber, set up an insurance company that provides insurance per mile driven. If somebody is not driving a lot of miles, they shouldn't be paying a lot of insurance. They specifically include ride sharing. They charge 5 to 6% per mile, and they do not charge the miles when the app is on. This is something that's limited to Uber. You have to tell them that you're a ride sharer. If you're working for Lyft or one of the others, you're not eligible for this coverage. The other one that became open was in Erie Insurance. They started providing a pilot program in Illinois and Indiana. They just amended their policy for a private automobile policy where they would cover this ride-sharing activity for any individual that had a business classification on their personal auto. And basically they took off the livery restriction. They took off they excluded that exclusion from their policy. I'm not sure what they were charged, what additional charge they were putting, but they were when they were introducing it, they said there are people that use their cars to deliver pizza. We asked them to get a commercial policy. We don't charge them extra. This is not that much different. I'm sure that the discussions internally in Erie were far more directed than that, but that was what they came out in some of their initial commercials for it. And that was it. If we looked at it a month ago, this is the list that I have now, we have Allstate that is doing this in Colorado, Illinois, Texas, Colorado. They expect this to cost an extra $15 to $20 a year to the driver's bill. USAA, again in Colorado. Colorado was one of the early states to come up with a comprehensive insurance law regarding ride sharing. So we see a lot of companies that are providing there. And they provide an endorsement to cover period 1, that period where the app is not connected. And they expect to charge an extra $6 to $8 per month for that. Again, farmers, NetLight, in Colorado, California, Colorado, have extended coverage that contingent period. MetLife is doing it with Lyft only. They're doing the data sharing with them. Farmers expects an 8% increase in your automobile policy. So if you have a insurance policy for $1,000 a year, you'd be paying an extra $80 for the insurance. Geico is providing a policy as a pilot in Virginia that provides coverage under all phases of driving. This is a new one that I've not been able to explore. I've just noted this in the press. And then Liberty Mutual, again, covering that period 0 when you're doing the non-personal riding, but no coverage once the app gets on. You know, these are interesting variations, but as you see, we're looking at a very small number of states. I don't know where Liberty Mutual is doing their pilot program. But we don't see Florida, we don't see Texas, we don't see New York, we don't see any place in New England, most of the central states, we don't see Oregon or Washington. It's a select number of states that's where the insurance companies are doing this as a pilot program and then hoping to learn from it. Let's go to the next slide. And at this point, I would like to respond to questions that you have. I should maybe end by saying that, you know, I'm really a fan of the concept of ride sharing. I think this unlocking of the value of underutilized assets is a great benefit. I think the provision of ride sharing to individuals that need that service but can't afford to purchase a car, senior citizens that may not have that may not be able to drive, their eyesight may not be good enough. One of the large benefits that's been noted by some of the groups is that this is really a program that helps the poor, those that can't afford to buy a car, those that generally take public transportation but occasionally need to have a drive to help them deal with some kind of emergency, getting to the school if the child is injured. You know, I think that this has some very positive impact, and in many ways it's a revolutionary use of technology. At the same time, I think it needs to be done in a way where the insurance issues and regulatory issues are taken care of. I think that the states, in their obligation to protect the public, whether it be the Public Regulatory Commission or whether it be the legislators, have to look very carefully at the ride-sharing services and the insurance coverage that's being provided, and so that we have a comprehensive solution and eliminate some of these insurance gaps. So let me take your questions at this point. Just one point I will also note that in the next couple of slides, for those of you who are viewing it later, I have a list of references that I think are interesting reading. You can Google ride sharing and come up with 5,000 references, and you know, these are some of the ones that I thought were particularly useful. So thank you so much.
Thank you very much, Dr. Staking. And We want to get to the questions sent in by those watching the webinar today. Again, if you do have a question, you may type it into the GoToWebinar interface. We'll see your question here in Lexington. I'll direct it to Dr. Staking, and we'll ask as many as time allows today. And we are rapidly running out of time today, but we did get this question in. This person was asking about the Lyft insurance coverage slide, Dr. Staking, and they ask, they said they don't quite understand when period 2 begins. You said that period 2 begins after match notification, but it looks like period 2 is the red-pink period, and period 3 is the green period. So they want you to clarify that if you can.
Let me clarify that real quickly. When this was first looked at, this was going back about a year or a year and a half. Once they were required to provide insurance coverage, they divided it into 3 periods. Period 1 was when the app gets turned on until a match is made. That's what's in our red line there. That would be period 1. Period 2 would go from the time that the match was notified until they picked up the individual. So that's would be a third point along that that curly Q diagram. And period 3 would be when they dropped off the passenger. Through legislation and regulation, Lyft and Uber and Sidecar have merged period 2 and period 3. They are now providing commercial auto liability coverage at $1 million coverage from the time the app is made. So today we could think of 3 periods. Period 0, when the app is off, where one is hoping that they're covered by their personal insurance, but the personal insurance may not be there if they discover that they've been doing ride sharing. Period 1 is that driver mode to the match notification, and then period 2 would be from the match to when the passenger is picked up and dropped off. I like to keep calling that first period period 0 because when you read about period 1, they're always talking about from the period then the app turns on to when the match is notified. So I didn't want to create confusion about what was period 1.
Gotcha. Okay. We have another question here, and this question refers to the independent contractor employee question, and they want to get your thoughts on that.
This is an ongoing discussion that is going to end up being settled by the courts or by legislation. I think it's something that every state needs to address. The standing of drivers as independent contractors is not clear. The ride-sharing companies make very persuasive arguments that their riders pick where they're going to drive, they pick which matches they're going to take, they pick the times that they're driving, etc., so that they are controlling much of the decision. The individuals that are opposed to this, that are filing suit against this, are saying, well, that's not really the case. We're not truly independent. We are directed by Uber. They're the ones that sets the fare. They are the ones that allow us to work or not. If our rating drops, if somebody gives us a bad rating, we can drop. If our rating falls below 3.7, I believe it is, you can be immediately dropped for the service. They're saying these are not independent contractors. They're very tied to Uber. But I think, I think that question is still open. But I think that the reason that it's being brought up many times is because of the insurance gaps. And I think it would be very useful if in the legislation and maybe within the ride-sharing companies, if they created a platform or if they worked out an arrangement with an insurance company to provide workers' compensation insurance, to provide the disability insurance. And that is something that could just automatically be subtracted from the fare that's being paid. It would probably be a small subtraction for the period that you're driving, for the period that you have your app on. So I think that is something that still needs to be resolved. In the recent Tennessee legislation, something that's been looked at as an ideal, they sort of define the drivers as independent drivers, as independent contractors. Their wording is not as precise as one might want to look at. I think that this question can still be answered there.
Okay. Well, we are just about out of time for today's webinar. Dr. Staking, thank you again so much for joining us this afternoon. Thanks also to Frank Paul Tomasello from the Griffith Foundation, and CSG enjoyed collaborating with Griffith to produce today's program. This webinar will be archived and available on the CSG Knowledge Center and on the Griffith Foundation website through December 31st, 2015. So if you missed any part of the program or would like to recommend it to a friend, it will be available soon. Be sure to check the CSG website for information about future eCademy webinars, and to check the Griffith Foundation website for information on risk management and insurance resources and programs as well. I'm Sean Sloan at CSG headquarters in Lexington. Enjoy the rest of your afternoon.